Hi everybody, this is Tor Storley and I am back with another video. Okay, we're going to continue from the prior video and we left off here in bond indenture. Now what I did just for the fun of it, I created this little workbook, this little notebook, and I'm using it to actually generate an indenture. So I use, in this case, I use the Edgar tools that I have made videos about before and Python. So as you can see here, you can import whatever you need. Now, I don't necessarily need this right now, but I use the OS. I don't use this. I don't think you use NumPy, but I use from Edgar. You have to install Edgar tools, and then you refer to the parts you need from there by saying import company. Also set identity, and we don't need the multi-financials here. Check out my prior videos from using Edgar tools if you're interested in more details about this. Then you set the identity, and I'll just create a dummy email here. And then I set up a directory where I want to save stuff. And then I can simply call Edgar and set up a company with his ticker. You can do that in a couple of ways. There's a number you can use too. But let's say I go with AbbVie here, and then I use this company, and then I get filings, and I look for these filings, and I load it into this variable. And then there's some additional code that will loop through this stuff and find one of these filings, and then save it as text. So it comes part of this. So as you can see here, now this happens to be not too long, but this is the text that it produced. But another thing it does, this notebook of mine, that is kind of useful. At the very end, as you can see here, I print the URL. And that means if you don't want to read it like in text format like I'm doing here, you can go to the Edgar or the Security and Exchange Commission's website, because I'm printing out the URL that relates to this document. So when I click there now, you can see now I'm inside Edgar system. So if I make this a little larger here, you can see this is AbbVie's indentures, as you can see here. And it's a legal document, and it's supposed to outline everything that they are doing and what they promise and so forth with this indentures. You can look at this, it's fairly long, but I just wanted to show you that you can obtain this stuff from the Edgar system. All right, very good. So let's close that and let's continue our talk about bonds. So we left off, I think we left off about here, somewhere here. So basically, what is a bond indenture then? It's basically a contract that outlines everything that the company will do and won't do. So you can see there is affirmative covenants and there is negative covenants. So affirmative is things that the company promised to do, like maintain insurance on their assets, pay taxes, comply with laws, etc. And the negative covenants basically says what they will not do. In other words, don't increase the amount of debt, because then the bondholders will suffer, because now suddenly the company is more risky. And pay dividends above a certain level if financial ratios deteriorate. So there are some things that it will do and some things it will not do that it promised and set inside this indenture. So why does it matter? Well, it protects the bondholders from company taking actions that will increase their risks after the bonds has been sold to them. So the investors, they don't look for more and more risk. They want to make sure they're guaranteed to get their return back. It's also very serious stuff, because, you know, if they break their promise, they can get into technical default, and it could trigger a financial crisis, even if the company still makes good on their coupon payments, because the bondholders can demand immediately repayment of the entire bonds. So that will cause a lot of stress to the company, obviously. So therefore, it's very important that they follow the contractual agreements that they set forth inside this bond indenture. Okay, What happens in bankruptcy? What is the pecking order in the bankruptcy? Well, the bondholder get their fill first. Then typically preferred stockholders get their fill, and whatever's left over, if anything, goes to the common stockholders. So I'll let you read through this on your own. Also, who among the bondholders gets paid first? For example, secured creditors are at the top. And you see here has preferred stockholders and then common stockholders down here. You can read this on your own. I'm not going to spend a lot of time. I'll make these documents available outside on my GitHub repository for these videos. Okay, now, what is the golden rule of bankruptcy? Well, there's a little example here that Hertz, I don't know if you remember this, but they went bankrupt in 2020 because of COVID. So nobody rented their cars because everybody was staying home. And so they suffered, and they eventually had to be paid in full, the secured creditors, that is, because of the car fleet had real tangible value. So they were able to pay those secured creditors in full. So here's the credit ratings, and Moody's, Standard & Poor's, and Fitch will perform such ratings. And there's the breakdown of what is investment grade, what is not. But what is important is that the dividing line between BBB or BAA and BB is one of the more important parts for a company, because either it's investment grade or it's not. So pensions funds, for example, insurance company, they need to hold only investment grade bonds. So if the grading agencies downgrades a bond issue, then that might be very risky for a company. Then there's some call and put provisions here, and there's callable bonds, there's puttable bonds. When I leave that in here, but I'm not going to go through this stuff. Here are some of the terms that you should be familiar with. Face value, par value, which is the amount that is going to be repaid at maturity, typically on increments of 1,000 for a bond. Coupon rate is the stated rate or printed rate on the bond certificates. And yield to maturity is basically the market rate that fluctuates up and down. Now, current yield is simply the annual coupon rate divided on the current market price. So it's also something called clean price, which is the quoted price excluding accrued interest. A dirty price is the clean price plus accrued interest, which means what you actually pay. Duration, how sensitive is the bond price to its yield changes? And I have separate documents for this where I use my community extension to calculate that, because I added in an extra function into it. So now there's 56 functions instead of 55 prior, because I added in this convexity calculation. And as part of that is related to duration. Credit spread, the extra yield over treasuries that compensate for credit risk. We talked about that earlier, where you took the risk-free rate and you added, depending on your investment grade, you added more and more basis point to it. Investment grade, rated BBB/BAA or above is considered relatively safe. And again, it all goes back to who you trust, right? All right, so there are some more terms there you can look at. And why do companies issue bonds instead of stocks? Well, one thing is the cost. The interest on bonds for the company that sells them is tax deductible. So dividends are not, okay? So let's say a company's in a 25% tax bracket and is paying 5% interest on bonds. They, in effect, are only paying after they compute the tax liability, they're only paying 3.75% after they take this deduction. Why? Because they're in a 25% bracket, so 75% times 5% is 3.75%. So equities doesn't have that kind of advantage. Control, by issuing bonds you are simply borrowing money from lenders. But those lenders do not own your company. They only promise for you to pay them, okay? But when you buy stocks, you basically own part of the company. So the existing shareholders' ownership change if you're selling more stocks, right? So you can look up this, and here are some final boxes with some information as well. So that's this document, and take a look at it. And the next thing we want to get into is something called bond amortization. As I told you before, this document here is talking about bond amortization using the effective interest method. So as you can see here, the effective interest method are factoring in the present value of the bonds. So in order to compute the interest that is paid, and also it calculates the discounted cash flows based on the yield. When you issue a bond at a so-called discount, meaning the market yield is exceeding the coupon rate, that's why you sell at a discount. Why? Because if the market rate is 10%, you could, instead of buying these bonds, you can simply invest in something that pays 10% instead of only getting 8%. And therefore, in order for you to kind of equalize that investment, you need to lower the price. So that's why the amount of money you're paying for these bonds might be lower than the face value of the bond. So a bond issued at a premium means that the coupon rate are greater than the yield in the market. So in other words, the company wants a little more money for paying the higher rate. So to equalize the market yield and the coupon rate. So that's why the bond will sell above face value. So there's an inverse relationship between the bond price and the market yield with respect to the coupon rate. So it's like a seesaw. When the yield goes down, the price goes up, and the coupon rate stays in the middle. That keeps the balance of this. Think of it that way. Here's an example for you. And again, we're using $100 face value here to keep the numbers easy. The fragments you're calculating out here can be applied to any bond value, okay? It's simply a matter of multiplication. So here we got $100 face value bond, 8% paying semi-annual payments. So that becomes $4 per period, twice a year. This is the issue date, January 1st, 2028. Here is the maturity date, 5 years later, on January 1st, 2033. And the payment dates are going to be on January 1st and July 1st for each year. So it's a pretty easy example. Is it like landing right on the same day? That reason is so we don't have to do fragmented interest calculations for the interest payments. All right, so it's 10 semi-annual periods because it's a 5-year semi-annual calculated bond. And we're using the actual as a basis, okay? Now the reason for this is because we're using our formulas from the community extension, okay? The financial functions community extension, the DuckDB version of it. Here, you can say all the tables will work based on the $100 face value, which is the price function we're using to return this. You can easily convert it, though, to whatever denomination you need to specify, whether it's $1 billion, 100,000, whatever it is. You can simply multiply it and it will be fine. So here is when you issue it at a discount, where the yield is 10%, coupon rate was 8%. So what we have to do here is we have to split that 10% annual return into 5% semi-annual return. And the same is true for the 8% coupon payment, would be 4% per period. So in other words, you're going to pay less than the face value. So you're selling at a discount, and we're going to have to amortize over the life of the bond here. So how do you do it? Well, you can calculate the price just like this by putting in this into the function, the price function, which is the bond price. Here is the settlement date, as it's sometimes called. What would we call it up here? We call it issue date, which is like a settlement date. Here is the maturity date. Here is the annual rate. And here is the annual yield. And then is it based on dollar denomination, semi-annual calculations, and we're on an actual basis. So that's a 1. Remember, there's a 1, 2, 3, and 4. So you need to look at the bond formulas to find out what to put in here. And then you round it here like this. Now, granted, some of these outputs here are a little bit short come because they didn't carry enough decimals, but you can calculate this on your own using these formulas. So the bottom line is, because you're selling at a discount because of the yield being higher than the coupon rate, 10 versus 8%, therefore your bond will sell at 92.2783 per $100 face value, which is a discount of $7.72 from the face value. So in other words, the discount will be $7,721.70 from the $100,000 bond issue. So how can you do this? Well, you can create an amortization table using this effective interest method. So how do you do it? Well, here I'm using a common table expression, setting up the beginning starting points using the price function, and then I'm adding in the coupon rates like this, which is representing the semi-annual numbers. Then you can set up using like zeros for when you first want to start this table. You start with a 0 in many of these fields. You have a carrying value, but typically you have a 0 in most of the other columns when you first start on the first period. And then because it's you union all, because you do a recursive calculations. And you can look at this yourself. I'm not going to spend much time on it. But here's the final portion of the query that basically creates the table. So as you can see here, this is what it returns. Your 92.2783 is what's called a carrying value. That will be the price you pay for the bond when you buy this bond. And then you're going to amortize it. So you're paying a coupon rate of $4 per 100, and you're going to pay it on these dates, right? So the first payment would be in June the 1st for $4. But as you can see here, you take the carrying value times the yield rate, okay? And that gives you the 4.61 here. So this changes all the time because you're going to start subtracting from it here, as you can see, the discounted amount. And based on that, therefore, this will gradually go up because you are selling at a discount, and it's going to work itself back to the face value of 100. We said 100. So this number will increase, but what if it was sold at a premium? It would decrease down to 100. But anyway, this is the amortization schedule, and as you can see here, there's the price and the journal entries. And for accounting, what you would do, here will be the first entry you make on January 1st when you actually sell the bonds. And you are owing the lenders, you owe them, when it's all said and done, $100,000 you're going to have to pay out. The cash you're receiving, because the bond was sold at a discount, you only got $92,278.30. And therefore, the difference here is the difference between this number and this number, which will be called discount on bonds payable. And the discount on bonds payable is a contra liability account. So what does that mean? Well, the accounting equations say assets equals to liabilities plus stockholders' equity if they carry stocks, which most of the big companies do. Therefore, what is considered a debit is simply meaning left. Left for what? Well, it all depends what accounts you work with. A debit on the asset side of the accounting equation is positive. That's why you're receiving cash here, right? If you paying out cash, it will be a negative, okay? This bonds payable is simply a long-term, I owe you $100,000 account. And because it's a liability, it will be increased when you give it a credit. So debit simply mean left, credit simply mean right, but depending which side of the accounting equation, a debit on the asset side is positive or increase, a credit on the liability and stockholders side is a increase. Okay, so here you owe 100,000. This is a contra liability account. That means it goes up on the debit side. Now, I don't want to get too technical here if you never took accounting, but this is kind of how you record this. Then on the first interest payment on July, because you're amortizing this bonds payable, the discount on the bonds payable. This, in other words, you have to take a portion of it based on the time frame that you cover. So your interest expense will come from that table that we looked at up here. So that will be this portion here, okay? Now, the numbers are not matching this because these have been rounded up too much. But if you calculate it again and you move more decimals, you're going to get these numbers. So here you can see this will be the 461 number you saw above, times obviously the 100,000, right? So that would be this number here. And the coupon payment will be this one. So that'd be 4,000. So when you record this, you record a 4,000 cash because now you're reducing your assets. So a credit would be a decrease in cash. An expense is an income statement account. And it increases by yield times the carrying value of the bond, okay? And of course, you are amortizing this using that effective interest method of 613.92, which is basically this number right here. So that's how that journal entry works. And then there's a couple of more, and I let you look at them if you're interested. The second half here then is dealing with a premium. And again, you calculate it again. The only thing that kind of makes the difference here is the coupon rate is greater than the yields, so the bond will sell at a premium. And that premium is this 108.5302. And again, you can compute amortization schedule using this code. And here you can see that now you work your way down towards the 100,000, or in this case, 100. We base it on 100 here. So once you do that, these will be the journal entries when you have a premium. Notice now you are using this adjunct liability account called premium on bonds payable here because you need to balance your credits with your debits. That's what accounting is all about. Always got to be in balance. This the right-hand side has to be the same as the left-hand side totals. So here is the premium on bonds payable that you're going to amortize. Here will be the first interest payment. This is how you record it. And here will be the second, actually the year-end accrual, which will be this one. You record your interest expense. And you can see it here. You simply use the number from the table above. Okay, and then you can compare it side by side. And the only reason for that is here is the face value. Here is the premium starting point. And here is the discount starting point. But when it's all said and done, you're working your way up to 100,000 here. You're working your way down to 100, I should say, instead of 100,000. That's how the amortization of bonds using discount and premium works. And that's based on general accepted accounting principle. Now, I know I went a little fast through here, but we're already late in this video. So that's the end of this video. And I hope you like my videos. Give me a like. And consider subscribing to my channel. It'd be fantastic. I look forward to see you again very soon in another video. Thank you.